Hey everybody, this is Ryan Mallory with a stock market update number whatever. I don't know what it is at this point, but in any case, let's get right into it here. We got the S&P 500. One particular thing that I could say about every day of trading this week, when the market gapped down or gapped higher, it faded the move. That was the big thing. There was no conviction in either direction this week. Yes, the market finished higher, but that was mainly as a result of the futures running the market up overnight and then fading it either a little bit or completely, like what we saw today. Monday, the futures were down over 100 points overnight. What happened? We gapped lower, way lower, and then we spent the rest of the day rallying from the moment that it opened up. Tuesday, we gapped higher, but we finished a little bit lower after filling the gap early on. Wednesday, we gapped higher, but then we finished lower. Thursday, we gapped lower and finished higher. Friday, we gapped much higher, like 40, 50 points higher, and then we closed well into the red. So it was a crazy week. However, the market opened, it faded that move each and every day. I've been short on the market this week. Why? On Tuesday, I added SDS. Did it give me any reason to close it out before the close on Friday? No, it didn't. The market's in a tug of war right now. It's not sure if it wants to take out the highs from earlier this month or it wants to break the lows from last week. It's a huge tug of war and it's stuck right in the middle here. However, there's this overarching bearish wedge pattern that has confirmed with last week's huge sell-off, the 188-point sell-off on the S&P 500, and it has not recovered. It has not broken back above that bearish wedge pattern and put this whole thing to bed. Instead, what you have is, with today's close, you have a market that closed below the 20-day moving average, it closed below the 5-day moving average, and it closed below the 10-day moving average. The next up would be the 200 and then the 50-day moving average. So technically, in the short term, the market's bearish. Also, when you zoom in a little bit more, you see that there's a bearish engulfing candle pattern over the last 2 days, also bearish. Now, does that mean that there's no bullish case to be made? No, there is. I'm gonna lay it out for you here. If we break the highs from earlier this month, the June highs, then I think you're gonna go ahead and fill the gap that was made back in late February. However, if you break the lows from this week, the lows that were made following the 188-point sell-off on Thursday, continuing on to the lows that were established on Monday, if you break those lows on Monday, then the next support level is going to be right here at the 276.45 level, or on the S&P 500, it would be 27.66. So that's the two levels that you need to watch here, because once we break the lows from Monday, which would be 29.65, you break those, it's 27.66 time. That's what's going to happen. Here's the other thing too that you have to be cognizant of. The market, it keeps floating higher when there's no volume. When you get the slightest bit of volume, maybe just a little bit above average, what happens? The market sells off. It cannot handle volume right now. You get the volume, you get the sell-off. So watch the volume levels. If we're opening up at first 30 minutes of the trading day, like 6-7 million shares traded on SPY, good chance that the rest of the day is going to be light unless there's some big bearish negative impacting news that hits the market. If you don't get that, the market's just probably going to float higher. That's what we saw on Monday, that's what we saw on Tuesday, and that's what we saw on Thursday. You just didn't have enough there to push it lower. The days that we got the negative news where the market paid attention to the bad news that was in place, like the COVID rate spiking, that's when you got the 188-point sell-off on Thursday. That's when you got the minor sell-off today. Now let's look at the SPY weekly chart here. You still have the bearish wedge pattern that was confirmed. It tried to break back above it on the weekly chart, could not do it. It tested the bottom end of the bearish wedge pattern. It failed to break back above it. It pulled back a little bit. It was still up on the week, but it was less than 2%. By and large, that would be a good week in a normal market. This isn't a normal market. When you're only up about 2%, that's a little bit more of a sluggish market these days. I know that sounds crazy, but that has been the case since the March 23rd lows were in place. So there wasn't quite the conviction that you saw. Also, huge resistance level overhead. It tried to break above it, did so momentarily, gave it right back. When you look at the daily chart of it, you could see that there was 4 days that we tried to get back above it. Last 4 days of trading. Could not do it on any of those days. Kept selling off every time that resistance level was touched. Tuesday, it tried to break above it, it faded. Wednesday, it tried to break above it, opened above it, faded. Friday, opened above it, faded again, finished red on the day. It's getting rejected at this huge resistance level. That's on the daily chart. This is what it looks like on the weekly chart here. How does the monthly chart look? Again, you have the resistance level. It can't break back above that resistance level. However, you also have a shooting star pattern forming. We're a little over 50 points up on the month. If that can't hold and we finish negative, we have about 7 days left of the trading month. If those 7 days result in the market finishing lower on the month, then you're snapping a 2-month winning streak for the S&P 500, and it drastically changes the tone of this market going forward because the entire month of June would have been in red. Nasdaq's a completely different story. This is your flight to safety. This is where people are going to when they're nervous. When they're not nervous, they're going to small caps, they're going to energy, they're going to financials, they're going to industrials. When they get nervous, they flee to the Nasdaq. That's why the Nasdaq was up on Friday. It didn't give up any of its gains. Above average volume for the 4th straight week in a row. What you want to watch for here, though, is for a turn in sentiment in this market, because if this market is going to go lower, and that's a big if still, it's going to take the Nasdaq with it. It has to. The market can't go lower if the top 5 biggest companies in the world, Facebook, Apple, Amazon, Microsoft, Google, Alphabet, cannot sell off. If they cannot sell off, it's going to put a floor underneath the market. So you need to watch those stocks to see if they start showing some weakness, and the whole broader market, including small caps, financials, and energy, also shows the weakness. Then you're going to start seeing the market pull back quite a bit. That's what we got on Thursday. That's what we've not seen since then. Now, how about the weekly on the Nasdaq chart? Closing again at weekly all-time highs. It's an impressive chart, man. I'm not going to disparage it at all. Now, the daily, it shows a little bit more indecision here. Maybe that's a double top forming. I don't know. It could be. We'd have to see a little bit more downside to confirm that. We'd have to see it break below 9,400 to get any sense that this is a legitimate double top that's forming. Right now, it's just trading at all-time highs. So don't get too ahead of yourself here. You need to see some confirmation to the downside first before you even think about wanting to get on the short side of this chart. On the long side, look, this thing is overbought. It's up like 18 out of the last 20 days on the Nasdaq futures. That is crazy. Honestly, I can't recall too many times in my trading career where I've seen an index trade up 90% of the time over that long of a stretch of time. 2 days basically over the last month. That is not a lot. And when you get that overbought, it can create some extreme pullbacks. So be careful. You also have a bearish divergence on the Nasdaq with the stochastics as the index on the daily is trying to make new all-time highs. This thing is actually putting in a lower high. Again, not anything major at this point, but it could be a sign pointing to some downside in the near future. Russell, very similar to the S&P 500. If it breaks Monday's lows, it's going to probably fill this gap here from May 18th. If it can break above the recent highs, then it's probably going to fill the gap from late February. But check out the resistance on the weekly. Clear-cut resistance. I've pointed this out in previous videos. It cannot break above it. It's struggling with it. That's a huge bearish sign. There's more volatility in the small caps, but nonetheless, I'm probably more bearish on the small caps right now than I am on the large caps. Now let's look at the VIX. Massive bull flag. Is it breaking out here? It broke out last week, consolidated some this week, but today's price action was important because as it pulled back and then consolidated, it didn't give up all of the gains from last week. That was huge because the tendency of the VIX of late has been to give up any and all gains that it makes in any previous trading session. That didn't happen this week. It gave up a good chunk of it, but it didn't give it all up. And today, it showed signs of that it's wanting to break out of this base pattern here and probably push to highs that are above the previous week. Now, do I think it's going to go back up to the 90 level that we saw before? Probably not. That was a rare thing. In October of 2008, when the VIX hit its extremes, didn't necessarily mark a bottom either in that sell-off. Instead, it went ahead to go even further down in price on the S&P 500, but the VIX never reclaimed its previous highs when it finally bottomed in March of 2009. Now let's go after some of these charts here that you guys are going after me on because you're saying, hey, you said this in this video and you said that in that video as if I got a crystal ball and I'm supposed to be 100% right on everything. No, I've never claimed to be 100% right on anything, but I'm going to follow up on those charts and I'm going to tell you what I think about them now. Take the first one, RCL. It's had a breakout. It broke above resistance at 50, 49.50. Now maybe it's bull flagging, but if anything, you need to watch this level at 54. If it breaks below 54, there's a good chance it's going to break lower and it's going to fill the gap from May 18th. That's in the 30. AAL, it's got a huge triangle pattern here. Do I think that's a continuation triangle where it breaks higher? No, it's not a continuation triangle because it's more than a third of its price rally. When it's more than a third, it's not a continuation triangle. It's a triangle that can basically say it's going to go either way at this point. It's got an equal chance of breaking higher, got an equal chance of breaking lower. At this point, looking at it, I'd say it probably breaks lower. I can't say that with any positivity. I got to wait till price confirms it. Once price confirms, then you can get long or short according to what the price actually does. SAVE, another airline. This is like a Dave Portnoy fanboy favorite, okay? Again, triangle pattern, maybe a little bit more of a continuation triangle than what we saw in AAL. However, it needs to hold the 20-day moving average. If it doesn't, there's not a lot of support underneath this stock. It could easily go back down to $11 or $12 a share. If it can break higher, sure, it has room to go into the high 20s, maybe even to the low 30s. However, that probably is a pipe dream because considering how much it's rallied, how much the market's rallied, you're looking for a miracle out of the market to push way beyond the all-time highs, for it to look completely past COVID, race riots, massive unemployment, Great Depression kind of economic numbers, and to all of a sudden just flourish again when nobody's flying. I wouldn't bank on that. SPOT, incredible breakout out of consolidation. This thing is a textbook breakout. Did so. It made it very difficult for trading because that huge gap from Thursday, it gapped above any ideal entry level and it just took off and never looked back. However, Friday's candle looks a little bit more like an exhaustion gap. It's a shooting star candle pattern, so I would expect going into next week, you're probably going to see a little bit of profit taking in this name. DIS, this is a huge risk play. COVID cases are spiking in Florida. Disney is trying to reopen, but you got Walt Disney in Orlando, Florida. What makes you think that they're going to be able to reopen when cases are spiking higher than they ever have before? Huge headline risk here for a possibility of them moving out the reopening of Walt Disney parks. You also have California COVID cases. They're spiking as well. Lots of risk there. You also have a head and shoulders pattern here. I don't like this chart at all. I think maybe going into next week, I might try to short this stock. Fitbit, guys, really? This thing got bought out by Google. Yes, I know there's some uncertainty with it over this past week here, but guys, I'm not sure what the reward is on this stock at this point. I would probably move on. The stock hasn't moved since November when they got bought out. I would move on from this trade. There's nothing here. Move along. SQ, another solid runner here. This one has been hard to trade on this rally up. Yes, I can see that in hindsight. It's gone from the 30s up to $100, pulled back a little bit to $98 a share. That doesn't mean that it was an easy chart to trade along. I've been watching this thing almost every day, at least every day, probably every hour. However, I was never able to find what I would call a really good, genuine trade setup. The best one was here at this little box formation here in the middle of April. It broke out of that, but it wasn't necessarily a very good breakout pattern. It wasn't like a flat line price level. It was more of like a slanted price level. It just didn't ever really give me a good risk reward. I never played it. Twitter, I got in this one today. I alerted the people in the trading block about it. I got in at 34.81. Let me tell you, as soon as I got in, it went up to 34.91. I started seeing the market pull back a little bit. I'm like, guys, this was early in the morning. I'm like, no, we're moving on from this one. We're not touching this. I got out at like 34.83. Made a whopping 2 cents a share. But guess what? It sold off and it closed at 33.41. So the amount of money I saved by seeing early on that the market was starting to fade saved me a lot of money. That was a trade I'm glad not to have been in. However, it's still a valid trade setup going into next week, so I would still watch it. If it can break that declining resistance, you got a little bit of a bull flag here in the short term, it might actually run. Look, I know that I'm not being all that bullish on a lot of these stocks right now. I know a lot of these stocks are popular, like GoPro and Fitbit and Square and UONE and all these other stocks that I've been highlighting in this video and in previous videos. But here's the thing, there's not a lot of good risk reward setups. Yeah, there might be a lot of good reward setups, but that doesn't mean that the risk that is inherent in each of those trade setups qualifies as a good trade setup. Because if you don't have the risk at least half of what you think the possible reward is, there's no reason for getting into it. If you think that, yeah, you can make $100 a share, but there's also $100 of equal downside on that trade, where's the trade setup at? That's not a good trade setup. That's an awful trade setup. So you need to be looking for things that, like, for every $2 that you can make on a trade, you only have a risk of losing $1. And then if there's massive headline risk on some of these trades, which there are, like if you trade a Boeing or you trade American Airline or Royal Caribbean, there is a lot more risk to the downside than what the charts are even showing. And I know that trading's pretty fun for a lot of you guys right now, okay? You're following David Portnoy and he's telling you horrible advice like stocks only go up. Long term, they do. Short term, there can be a lot of calamity. Okay, I find the guy entertaining. I like the guy. I like his pizza reviews. But don't be following him blindly into these things. He's been doing this for like a couple months, and it was only like a couple months ago that the guy was short on the market and he was losing his head on it. He's only doing it now because it's the path of least resistance, which is fine. But where is he talking about risk? Where is he talking about that in relation to reward? He's not. And look, if you lose all your money, he doesn't care, but you do, and I don't want you to lose that money, okay? So look for the risk, look for the reward. Again, I don't have anything against the guy. He's entertaining, but look at him as an entertainment factor, not as an actual person to follow into trades. With that being said, I encourage you to like and subscribe to my videos. I do about 2 of these every week, put a lot of blood, sweat, and tears into them, research, analysis. Appreciate you guys continuing to follow me. I appreciate the feedback. Put some comments down below. Tell me what you think. If you think I'm off base on something, tell me. I'm fine. I enjoy them. I'll go back and forth with you. I appreciate that. And I learn a lot from you guys in the comments. I really do. And I'd encourage you to keep giving me that feedback. Take care. God bless.